We are live.
Hello, good evening, everyone, and welcome to Marcellus's Kings of Capital webinar. We have today the fund manager for KCP, Tej Shah, joining us, and we're going to discuss the Q1 portfolio updates, performance, and a very interesting subject today, right? As they say, history repeats, or at least it rhymes. Either way, there's a lot to learn from that. So we'll hand it over to Tej to take us through what we can learn from history of the financial services company. Thank you, Tej. Over to you.
Thank you, Salil. So we'll focus on learning from history of financial services first. And the reason that at Marcellus we focus a lot on history is we believe that there are a lot of learnings that we can incorporate when it comes to investing, and especially investing in financial services, given the way things have panned out in the past. Because if not in the exact form, but cycles tend to repeat the way that they have historically. And because future is not predictable, there is a very high likelihood that our predictions might turn out to be false. But there are patterns that we can find out based on the behavior of various players and basis the way cycles work, human psychology works, that we can learn from and implement in the way that we invest in financial services. So the way we'll run this is, first we'll focus on lending within financial services, and then we'll focus on insurance. The way a typical credit cycle works is we start off with usually a good cycle. We start off with discounted rates being offered on either loans or premiums, and players who are focused on market share start off a good cycle with extremely low prices. They start offering, say, home loans at low prices. They start offering insurance at low prices. That eventually leads to supernormal growth, because in even a semi-efficient sort of market, most customers would be attracted to low interest rates and low insurance policies with low premium rates. Over time, this supernormal growth rate attracts more people into the market, because from the outside, it looks like it is a sector or it is a segment which is growing at a very rapid pace, and therefore there is a lot of opportunity in that segment. As more people enter in, it leads to oversupply at times, and that is where the cycle starts turning. This is where usually the cycle is at its peak. Post a period of supernormal growth, a lot of people and a lot of players entering into a sector or a segment, leading to excess supply, and either the customers end up being over leveraged, or that is when the cycle starts turning and we start seeing heightened NPAs. Eventually, this sort of thing ends up very badly. That is when eventually we see a meltdown in share prices. And in this period between the supernormal cycle running at supernormal speed, overbuilding of capacity, it is in this period that we actually see a super run up in share prices, especially for players who have engaged in this sort of discounting and these sorts of practices. After we see a meltdown in share prices, we again see cleanup of the balance sheet. Either the regulator intervenes, or large shareholders start pumping in money, or we see that the same old players have learned their lesson. And then we go through a period of recovery. But again, as we see a lot of capital coming in, as we see balance sheets getting cleaned up, the cycle starts repeating itself. And we have seen this historically multiple times. Financial services is peculiar for this sort of cycle. Capital Returns is a book which illustrates this point very well. And if you were to take an example of this cycle with a specific name, this is a large renowned NBFC which has been in existence since a long period of time. Again, it started off by offering extremely aggressive rates between 2015 to 18, that resulted in a 38% loan book growth. This is on a compounded basis. Stock price also compounded in line at about 30%. So during this part of the cycle, asset quality is robust, loan growth is robust, things look hunky-dory. And this is a period of usually a benign macro, a lot of euphoria. And this is when a lot of other players also start entering this market. So if you remember, if our viewers remember, 2015 to 18 was a boom period for NBFCs and housing financiers. This is a time period when a lot of companies were leveraged, and especially housing financiers were leveraged 10 times, 12 times, and were growing at 30 to 35%. That led to a buildup in capacity. People say, the worst of mistakes are made in the best of times. That is what happened. And that was followed by 2018 to 2021, which was ILFS crisis. Indiabulls itself plummeted. We saw DHFL, we saw Yes Bank, and we also saw eventually COVID. So that's what happened. 38% stock price CAGR, 30% loan book growth, a lot of players entering, eventually ended up in the stock price plummeting 85% between 2018 and 2022. What used to be a model which was leveraged 8 times is currently leveraged 2.5 to 3 times. Indiabulls has cleaned up its act and has now become a significantly more asset-light model. And again, we are entering a phase where we are seeing a lot of euphoria in the market. We are seeing all types of lenders growing at 25 to 30%, especially because we've gone through a long period, not only FY18 to 22, but even a longer period for some of the PSU banks, some of the corporate lenders, where we have seen almost a 14 to 15-year period of assets being written off and balance sheets being cleaned up. So we are therefore entering again a period of high loan growth, a lot of banks, a lot of NBFCs seeing high stock price compounding. And I believe that we are entering or have already entered a period of oversupply and overbuilding of capacity when it comes to lending. Another example, and which is again a classical sign when we see the cycle heating up, is when we see leverage across the board increasing. So the blue line on the screen is Yes Bank, the red line and the gray lines are HDFC Bank and Kotak Bank respectively. If you were to see post the Lehman crisis, between 2007 and 2015, HDFC Bank and Kotak Bank saw their leverage consistently reducing. We saw HDFC Bank's leverage go from about 14 times to about 10 times, Kotak go from about 11 times to about 7 times. On the other hand, during the same period, we saw Yes Bank not only growing at a rapid pace, but we also saw till its 2014 QIP, we also saw its leverage increase from about 10, 11 times all the way up to 16, 17 times. And this again played a key role in the unraveling of Yes Bank. And when at 16, 17 times you make even a tiny mistake, it results in the balance sheet getting completely destroyed. And 16, 17 times leverage implies that for every 5 or 6 rupees of equity, you are having about 93, 94, 95 rupees of debt. For that sort of a leverage, on 5 rupees of equity, 93, 94 rupees of debt on that 100 rupee loan book, even if you make a mistake worth 2% of that loan book, that can wipe off about half of the equity. And that is why we believe that while in euphoric times, and those euphoric times, as in the case of Yes Bank, can last for a long period of time, we believe that we cannot risk capital at about 17, 18, 19, 20 times leverage. And this sort of leverage is existent even today. We've illustrated this in previous webinars. We've seen a lot of PSU banks, which currently have about 18 times, 20 times, 22 times leverage. Even SBI has leverage in the same vicinity, which is around 20 times leverage. And at that sort of leverage, even a mistake of about 2% on the loan book can wipe off half of the equity, and things can unravel pretty quickly. Therefore, we've focused on in KCP across most of our portfolios, the likes of HDFC Kotak, which have about 7 times leverage in Kotak's case, 8, 9 times leverage in HDFC Bank's case. That leverage in HDFC Bank's case will go down even further as it merges with HDFC Limited. And this is with HDFC and Kotak's pristine asset quality and risk metrics. Now, moving on to insurance, while things unravel pretty quickly when it comes to lending, given the leverage nature of the balance sheet, similar factors and a similar cycle plays out in insurance. And insurance is extremely lucrative, looks extremely attractive from a discounting perspective, because what usually happens is in insurance, you're trading a piece of paper, a piece of contract for cash flows which are upfront. And all you are underwriting is that you'll pay out some money in the future if a specific event occurs, and you're getting cash flow upfront for that. We've taken the example of group health insurance on this slide, and how over FY17 to FY22, FY23, some of the publicly owned insurance companies, some of the PSU owned insurance companies wrote large amounts of premium, increased their market share at about 35% CAGR. And all of this was done at the expense of the balance sheet, at the expense of the P&L. So in FY17, the four PSU general insurance companies had written about 20,000 crores of group health premium, which increased to about 120,000 crores of premium, which is a 6x, which is a sort of a total cumulative premium of 120,000 during this 5-year period, at about 25 to 26,000 crores of losses. Now, they kept on writing this sort of insurance over a long period of time, despite increasing losses, just because they were seeing top line growth and they were seeing market share gains. We can also see the same loss ratios, or the same segment that the private players were operating in, and they were operating in the same segment at a loss ratio which was significantly lower. So FY17, FY18, FY19, FY20, all of that combined, for every 100 rupees of premium written, PSU insurers were losing about 10 rupees. During the same period of time, private insurance companies were writing premium in the same segment. For every 100 rupees, they were paying out only 75 rupees in claims, and they were making 25 rupees. During the same period of time, standalone health insurance companies, for every 100 rupees of premium written, were earning about 40 rupees on that 100 rupees of premiums written, and were paying out only 60 rupees in claims. So we can see that it's not that the whole market was a challenge. All the loss-making business was being taken away by these four PSU general insurance companies, while the private insurance and the standalone health companies were writing business in the same segment at a significantly higher profit margin, because at 100 rupees on average, the standalone health companies and private companies were making about 30 rupees, while the PSU general insurance companies were losing about 10 rupees. And this continued for a long period of time. This is all public data. This is from the CAG report on PSU insurers. This report came out in FY22-23. Even after that, even after the report came out, the same sort of state of affairs continues for the PSU general insurance companies. We again take specific examples. Say TCS, which is a well-known large company. All PSU general insurance companies used to do extreme amounts of discounting on group health. In this case, TCS and LIC Group are the examples that we have chosen. So in the case of TCS, total premium collected, for example, for the year ending March 17 was 850 crores. On that, the claims incurred for the general insurance company who wrote this was 890 crores, and therefore they incurred a 50 crore loss. Based on this experience, most insurance companies would revise their premium amount and would start charging more. But in this case, we can see that even next year on TCS, they lost 40 crores. On 900 crores of premium, 950 crores was the claims outgo. And this keeps on repeating every year. Again, this is all public data highlighted by the CAG report on PSU insurance companies. And this keeps on continuing for the next 3 to 4 years. Same thing with the LIC group. Because this is easy business to write, because this is business which is written basis relationships, because this is a business where you can see 1,000 crores, 1,100 crores, 1,200 crores of premium inflow in a single year from a single group. These companies, PSU companies, have kept on increasing their market share despite seeing either high amounts of losses, which is 100 crores of losses on each account, or insignificant amounts of profits, which is the case with LIC as a group. On the other hand, what we see with well-run private insurance companies, ICICI Lombard, for example, is one of our holdings in Kings of Capital and Consistent Compounders and other portfolios. We've seen them focus only on profitability. In the case of ICICI Lombard, we have seen between 2013 to 2021, ICICI Lombard was happy giving up market share. And this is the time period when we saw PSU insurers ramp up market share at the cost of profitability. ICICI Lombard was ceding market share, went all the way down to 4.5%, which was at 10% in FY13. And over the last 2 to 3 years, they've again started ramping up market share as they've seen pricing improve. So as it stands today, PSU insurers, as we saw in the earlier slides, have realized that this is a loss-making business. Whatever business they wrote over the past 6-7 years, they're seeing claims hit consistently on those business lines. ICICI Lombard, on the other hand, stepped away from this business, let market share go away, did not focus on top line, did not focus on market share, and only focused on bottom line. And this takes a lot of character, we think. This takes year after year, a lot of discipline for market share to go from 10 to 8 to 6 and then to 4.5%. And then the ability to go from 4.5% to 6.5% in about 2 years' time takes a lot of investments, character, and discipline. And this is what we have seen historically, that it can go on for extended periods of time, but usually it's a disciplined, profit-oriented risk manager which eventually prevails and which can eventually survive multiple cycles, gain at the expense of competition over a long period of time, and eventually end up being the most profitable and dominant player in that sector or segment. Now, coming to the current cycle, if we were to focus on some of these numbers, okay, we can focus on, first of all, the 2003 to 4 cycle. SBI, PNB, Canara Bank, Bank of Baroda are the examples that we have taken for PSU banks. Immediately after 2003, again, 2003 is a specific year we have chosen because that was the beginning of a new credit cycle. From 1993 to 2003, we've not seen a decent credit cycle on the back of challenges in the NBFC sector in India, Asian financial crisis, on the back of a lot of challenges on the retail portfolio of some of even the private sector banks in 99, 2000, 2001. For a very long period of time, we had not seen a great credit cycle. 1 year after the beginning of the credit cycle starting in 2003, we saw SBI, PNB, Canara Bank, Bank of Baroda do extremely well. These stocks went up by, on average, about 150, 160%. On the other hand, HDFC Bank went up by only 60%. But as we start extending time periods, we see that over 5 years, over 10 years, over 15 years, SBI versus HDFC Bank or a PNB versus HDFC Bank, there's no comparison in terms of returns. On average, some of these PSU banks went up by about 5 to 6 times. On the other hand, Kotak, obviously from a very small base, but HDFC Bank went up about 40 times. And the largest reason behind this result is these PSU banks focused on extraordinary growth during a good period, and they faltered during a bad period, and therefore ended up being extremely pro-cyclical. So for example, during the GFC, after the 5 years of a good credit cycle between 2003 to 8, SBI, PNB, Canara Bank saw massive amounts of NPAs. On the other hand, HDFC Bank, Kotak Bank survived the GFC extremely well, did not see an increase in NPAs. Similarly, again, after 2009, if we were to look at 1-year returns, stock price returns, 68% on average for the PSU banks, but 35% for HDFC and Kotak. However, if we were to take a 5 and a 10-year view from there, PSU banks in that 10-year period actually did nothing. We saw Bank of Baroda, Canara Bank, PNB actually delivering negative returns. On the other hand, a Kotak and a HDFC Bank went up by about 7 times in a 10-year period. And that brings us to this cycle again. Canara Bank, SBI, PNB, Bank of Baroda again have done exceedingly well since March 21, 100% growth, almost doubled. On the other hand, HDFC Bank and Kotak Bank have delivered no returns in the past about 2 years' time. Again, this can be, the way we need to differentiate this can be on the back of HDFC or Kotak delivering poor fundamentals, but we'll cover that in the coming slides. That's not the case. They have compounded profits as they have usually done at about 20%. However, all the PSU banks have seen massive reduction in NPAs and are benefiting from a great benign macro. But as we've seen historically, over a 5-year, over a 10-year period, HDFC Bank and Kotak Bank usually trump all of these PSU banks, not only in fundamentals, it's driven by fundamentals, but also in terms of stock price performance. And therefore, we believe that this is bound to reverse as long as HDFC and Kotak are delivering the fundamentals that they've done historically. The share price performance is bound to reverse. This time, it's been an extended period of time that the share price performance had diverged. For HDFC and Kotak versus the PSU banks. But we believe that when the reversal happens, the reversal will also as sharp as this. Now, moving on to our portfolio, we'll cover off how we've seen share prices move, and then we'll move on to fundamentals for the Kings of Capital portfolio. So between July 20 to October 21, July 20 is when we launched the Kings of Capital portfolio. The portfolio delivered about 43% returns. And this is on the back of solid recovery from COVID. Most people expected financials to not do well post-COVID and an extended period of pain on credit quality. But the precise reason that we launched the portfolio was we thought otherwise. We thought India will do well. We also thought that especially the financial services companies that we own are some of the best risk managers, and they will come out of COVID better than most other lenders and most other insurance companies. So on the back of that, the portfolio did well. Between November 21 and March 23, the portfolio corrected by about 18%. And this was on the back of not fundamentals undergoing some dramatic change. Through this period also, fundamentals kept on growing profits kept on growing at 20-25%. However, the stock prices corrected on the back of rising interest rates globally, on the back of increasing commodity prices, and a significant recovery in asset quality for corporate-led lenders and PSUs. As we see again this year, this financial year, we are again seeing an uptick in share prices for the type of companies we own. The portfolio has recovered. So if 100 rupees went down to 82 rupees between November 21 and March 23, 82 rupees has now recovered to about 98-99 rupees this financial year, and we've broken even. However, the good part is while we have lost time during this time period, November 21 to September 23, the underlying compounding engine of profitability has continuously grown at 20%. So while stock prices have derated between November 21 and March 23 and September 23, we've not seen any slowdown in profit compounding. So as soon as we see the same sort of multiples as in November 21, or we see profits compounding at 20% for the next 1 or 2 years, we'll make up for this lost period of time. The other good part is these companies have made significant investments in technology and distribution over the past 2 years. As a result of that, we are actually seeing fundamentals improve from their own historical past and also versus the rest of the industry. So we'll move on to the fundamentals that we are seeing. If we were to focus on the FY23 numbers, we're seeing that the weighted average profit growth in FY23 for the portfolio is 40%, and the weighted average operating profit growth is about 26%. The good part of this slide is that this 41% weighted average profit growth is broad-based. Whether it be HDFC Bank growing profits at 19%, which is the largest bank and the largest stock we have in the portfolio, or whether it be Home First Finance, which is the smallest NBFC we have in the portfolio, that's also growing profits at 23%. Similarly, with the case with some of the non-lending companies that we own. Prudent Corporate, smallest company, growing at 46%. ICICI Lombard, insurance company with 10% market share, growing profits at 36%. And therefore, we are seeing healthy fundamentals across the board, significant market share gains as well. However, if we were to look at the 1-year share price returns, that's at 10% versus the 40% PAT growth or the 26% operating profit growth that we have seen in the portfolio. What that means is, while profits have grown at a healthy clip, share prices have not kept up pace, and therefore all of these stocks are generally available at a valuation which is lower than last year's valuation. On the other hand, as you can see, the market's valuation has gone up. The underlying markets have not compounded profits at 40% or at 26-27%, but share prices or the market is generally up by more than 10% over the past year. What that means is we are actually seeing share prices not going up in line with earnings, and these share prices are becoming cheaper with every passing quarter. With every passing quarter of 20% growth and without a commensurate growth in similar share prices, we are seeing that the P multiple of these stocks are falling. What we can also see is the FY23 profit growth is significantly higher than FY19 to 22 growth. So while in FY19 to 22, we saw 30% PAT growth, 16% operating profit growth, those numbers have significantly improved in FY23. And we believe that this is likely to continue. These sort of fundamentals can continue for some of these companies and for most of the portfolio as a whole, even as we proceed in FY24, FY25. And again, this is one of the reasons that we believe that these fundamentals will continue. If you were to look at Q1 FY24, there has been no slowdown in fundamentals versus FY23. YY loan growth during the quarter at 23%, YY PAT growth at 35%. Asset quality is not a challenge at all. ROA and ROE as a result at almost all-time highs for almost all companies. So, for example, for Kotak Bank, 2.8% ROA is not something that we have seen in Kotak's history. For Bajaj Finance, 5.5% ROAs is not something that we've seen in its history. Cholamandalam Finance, 2.5% ROA, almost at an all-time high. Similarly, for the non-lenders, we are seeing healthy performance across the board. HDFC Life, while we are seeing a 13% growth in premiums, this is significantly higher than what was earlier expected. On the back of the changes in the budget on guaranteed income policies, it was expected that HDFC Life might not be able to even post positive growth this year. But even in Q1, which is seasonally a weak quarter, they've grown at 13%. Similarly, Prudent Corporate is doing well on the back of solid inflows from retail investors in SIPs and mark-to-market gains. ICICI Lombard is growing top line at 23%. The 12% bottom line growth, we believe, will likely be more than 20% for the year as a whole. Info Edge is also doing well. There is obviously some bit of slowdown because of IT hiring, but they've diversified well into non-IT as a segment. And they are also seeing about 35 to 40% bottom line growth. So extremely healthy fundamentals across the board, and we believe that this is likely to continue. The biggest reason we believe that the share price growth is not being replicated and is not commensurate to the 35% profit growth is the net NPA number. Because the net NPA number, not only for our lenders, but also for the rest of the system is so low, the market is not differentiating between high quality lenders and other lenders. Because even PSU banks are reporting significantly low NPAs and they are available at significantly lower valuations, the flavor of the season or the market is being attracted to most of these PSU banks. While there is no significant deterioration in the fundamentals of a HDFC or a Kotak, the relative gap has closed down. And this is where we can highlight the relative gap which is closed down. If we were to look at 17, 18, 19, 20, 21, during all of these years, the YOY loan book growth for KCP as a portfolio was extremely healthy versus the Bank Nifty. Since FY22 and FY23, again, KCP loan growth is extremely healthy versus the bank Nifty. However, that gap has closed down. If we were to look at gross NPAs, again, gross NPAs for the KCP portfolio move in a very narrow band because these are great risk managers. However, for the bank Nifty, that number is coming down. Again, ROA, ROE for KCP as a portfolio is at an all-time high. ROE for KCP as a portfolio is now at about 20% versus 15 or 16% historically, which is the highest that it has been. And this is at a significantly lower leverage than the bank Nifty, as we can see on the screen. So at a fundamental level, we are seeing KCP deliver better than expected ROE, better than its own history on ROE, significantly higher growth, solid asset quality metrics on an absolute basis. And the only difference is that the gap between bank Nifty and KCP has closed down. But as we explained before, this is a cycle. This is what happens in a benign cycle. But as the cycle turns, the KCP lenders move in a very narrow band when it comes to asset quality. However, the rest of the sector sees a downturn. What this has resulted in is most of the KCP stocks are now available at valuations which are the lowest in about 5, 6, 7 years. So if you were to look at HDFC Bank, it's available at a valuation which is about 30% lower than FY18-19 and about 10% lower than FY16. Kotak Bank is available at a 40% discount to 18-19 valuations. Similarly, 40% discount to valuations in FY16. Same is the case with HDFC Life, ICICI Lombard, Aavas Financiers. Bajaj Finance also, a lot of people believe that is extremely expensive, running ahead of its own history on valuations, but not the case. It's lower than FY18-19 on valuations and the same as FY16 on valuations. So what that has led to is extremely high growth numbers, which is the bar graphs in blue. What we have seen is with every passing quarter, there has been no slowdown in growth, 25 to 30% growth. However, if we were to look at valuations, which is the line in gray, we have seen valuations coming down as a trend line. So what used to be about 30%, used to be about 30x on P multiple is now at 22, 23, 24 times. Similarly, an upward trending line on return on equity, upward trending line on profitability, upward trending line on growth, but reduction in P multiples. If we see this with every passing quarter, obviously these stocks will become cheaper. And we believe that this is a therefore great opportunity to buy, where stocks are growing at 20-25%, they're growing profits at 20-25%, but share prices are not moving in line. Now, one question we get is this because this was already baked into the stock price? Or is this because these stocks have disappointed on earnings? But that's not really the case. So if we were to look at some of these stocks, that what was the expectation on earnings growth at the beginning of FY23 versus what they actually delivered, we are seeing a beat across the board and absolutely no disappointment. Kotak Bank, for example, in April 22, the consensus estimate was will deliver 48 rupees of EPS. It actually delivered 75 rupees, which is almost more than 50% higher on earnings growth. Similarly, with HDFC Bank, no disappointment in earnings, exactly in line. ICICI, Axis, Bajaj, Chola, all of them also beat estimates by a margin. So the reduction in P multiples or the derating is not driven by any disappointment on estimates. There is no disappointment in estimates. There is no slowdown in growth. It's only because the market is finding attractive pockets, maybe on valuations somewhere else. And that is where these stocks are correcting either marginally or they are seeing a time correction. Coming to what are we seeing in the rest of the market, the top performing banking stocks when it comes to the past year, there are a lot of stocks which have doubled, tripled. They're all stocks which have not delivered any sort of fundamental performance or any sort of wealth creation in the preceding 5 years or 10 years. These are all stocks which are coming on the back of a very bad asset quality cycle. And this is why we were pointing to history. And this is why this is a webinar on learning from history on financial services. We're going through a period of cleanup, and we've gone through a period of cleanup. Again, we are going through a period where some of these banks have seen capital infusion, some of these banks have seen NPAs being written off, and they are reviving. However, they have no history of wealth creation, good capital allocation, etc. If we were to look at this from another lens, if we were to look at some of the banks who've done exceedingly well, they are the same banks which have had the highest amount of NPAs historically. So the way we see this is higher the gross NPAs, higher has been the usual share price performance since COVID. So for example, Union Bank, Bank of Maharashtra, Bank of Baroda had 10 to 15% gross NPAs. They saw a significant correction during COVID. And on the back of that, since then, they have seen share prices compounding at 45 to 50%. And this is again early part of a cycle where a lot of these companies with bad balance sheets, significantly high NPAs, have done exceedingly well. On the other hand, HDFC or a Kotak were already at 1.5 or a 2% NPA. Even if they see a great macro, benign credit conditions, that 1.5 to 2% NPA can go down at best to 1%. They don't get a disproportionate benefit of a great macro. On the other hand, a bank at 10 or 15% NPAs, if it sees a benign macro or great credit conditions, it will see 15% NPAs go down to 8%, 7%, 6%, and therefore a great kicker on ROAs and ROEs. On top of that, these are the same stocks which had corrected 40, 50% during COVID, while a HDFC or a Kotak had corrected only 7%, 10%, 15%. That is why, while we are invested in companies which have been superb on capital allocation and have avoided poor quality lenders, we have not seen similar share price compounding. And if you were to wear a purist sort of a hat, what does 15%, 10% gross NPAs imply? It implies that out of every 100 rupees that these lenders had lent, 15 rupees eventually went bad. On the other hand, for HDFC or a Kotak, for every 100 rupees that they had lent, only 1 or 2 rupees went bad. And when we see 10 or 15 rupees out of every 100 rupees going bad on a business which is leveraged 15 or 20 times, we can see more than 2 times your net worth actually getting wiped off, and eventually capital infusions from the government saving these banks. And therefore, as far as possible, we have stayed away from the top half of this table. We've concentrated all our holdings on the bottom half or close to the bottom half of this table. Because we've been conservative, we've actually not enjoyed the benefits that some of these PSU banks have seen on stock price compounding, but we are focused on capital preservation. We believe that the cycle can turn very quickly, and as that happens, we will actually get rewarded disproportionately because most of these companies are doing exceedingly well on fundamentals. So Salil, I'll stop over here. Happy to take questions.
Right. Thanks, Tej. So people who, if you have questions, just put them in the Q&A box and we'll try and take as many as possible. Tej, the first question, there are a couple of them on this. One of them comes from Anjal Gupta, and I think that these questions are effectively around what you explained, that the earnings have been strong, they've been growing, but the share price has not. So there is a clear kind of derating in the chart that you showed there. Now, what would it take for this to reverse? If fundamental performance is not the reason for derating, then when can that change, or what will change it?
So historically, we've seen that usually these sort of junk rallies where these stocks have done extremely well, they turn, or a HDFC or a Kotak start doing better when there is an external shock, or there is some sort of macro event which plays out. It's just that we can't predict the timing of that macro event. We can't predict the timing of when the junk rally will end. And it is usually quite sudden. Like we took the example of some of the banks and NBFCs which have blown up in the past. DHFL was AAA rated till about Jan of 2018. In about 3 months' time, AAA rated NBFC went to a default rated NBFC, which is a credit rating of D, and the share price corrected by 95%. And Yes Bank went on for about 15 years. It kept on increasing leverage and kept on growing at 30%. So we just can't predict the timing of these things. All we are focusing though on is, in the meantime, is a HDFC Bank, is a Kotak Bank losing market share? Are they growing at 18 to 20% as we expect them to grow? The fact of the matter is they're actually growing at more than 18 to 20%. So they have arrived at valuations also which are significantly lower than their own past. And this is in the context of a market where valuations are higher than its own history of the past 4 or 5 years at least. And the way that investors who are already invested or who want to invest in this portfolio should look at this is a portfolio which is growing earnings at about 25% with return on equity of 20% and is available at a P multiple. And this is a trailing P multiple of 23, 24 times. So 24x P for something which is at 20% ROE and 25% growth versus the market itself today is trading at a trailing P of 23, 24 times, has a return on equity of 12, 13%, usually in the long term grows at 12, 13%. So you're getting a basket of stocks which is available at the same valuation as the market, has obviously the qualities of a management team of a HDFC, Kotak, Bajaj Finance, etc., and with significantly better fundamentals. So therefore, it's an extremely lucrative opportunity from a valuation and a fundamentals standpoint. When this exactly reverses, when the stocks start re-rating or start performing better on a relative basis versus some of these stocks, is only a matter of time. But when it happens, it will be quite swift.
Right. In fact, there's a related question, a couple of questions actually. One of them is from Nitin Jain, and he asked that when we have so much analysis of this trend, then why don't we take short-term benefits by investing in the trend? And so, sir, you have your answer there, right? You can't really time when things go down. There will be a macro event which will lead to, like Tej explained in earlier case, a 95% decline in a very, very short span of time. So we did rather not do that. Tej, one question now is on, for Bajaj Finance, is Jio's entry a threat, or how does it overall impact the NBFC space in general, I would ask?
Sure. So in the case of Bajaj Finance and Jio specifically, what we have seen historically is there are a lot of corporate groups which have first of all tried and entered lending as a segment. We've seen a lot of auto financiers do that because they are already manufacturers or they are auto OEMs themselves. We've also seen large corporate groups, say L&T Finance, has already been there since a long period of time. We've also seen, say for example, Bajaj Auto recently launched its own two-wheeler financing company. But the challenge that we've historically seen is when some of these large groups try and leverage the benefit of their existing business and into a lending business, which is when an auto OEM starts doing auto financing, or when an infrastructure business, which is L&T, starts doing infrastructure financing. Usually the profitability resides in the core business, which is the original entity or the parent entity. Similarly, with some of the auto financiers, we've seen that they've seen 8 to 10 to 15% gross NPAs, while the core auto business or the auto OEM is doing extremely well on profitability. This is because the pressure always on the lending entity is to improve the profitability, sales machinery, sales growth, market share of the parent entity. And that conflict of interest usually ends up badly. The second point on Jio is whatever we know from their public statements or from their media statements, whatever we know about their lending plans, we know that they are going to enter into consumer financing, merchant lending. They are also going to enter into insurance. Now, all of this put together, they have about 1.2 lakh crores of capital. So 1.2 lakh crores of capital for all of these industries put together, we believe that parallel that people draw to Jio's entry into telecom is not really valid over here, because lending as an industry alone has about 20 to 25 lakh crores of capital already invested with incumbent players, which is banks and NBFCs. So on that, 1.2 lakh crores is about 5% of incremental capital coming into the sector. Secondly, insurance as an industry has, again, a lot of capital already invested into the sector. So Bajaj Finance today has 2.5% market share. If Jio is able to crack the code, does extremely well, there is enough space for Jio to do well. Secondly, like I said, we've historically seen that these things take up time to build up. We've seen a lot of corporates and new entrants enter into this space, but usually it's been a mixed bag on execution. Thirdly, in the case of Bajaj Finance, we've seen the management's ability to maneuver various cycles extremely well, especially when it comes to some of these events which most investors, even we as investors, have believed that it's a black swan event. Whether it's COVID, whether it's ILFS, whether it's the entry of other new players into the sector, Bajaj Finance has maneuvered all of that extremely well. That is because usually the market has underestimated the ability of the management team to maneuver a crisis, but overestimated the risks of that crisis. And this slide is a solid example of that. Bajaj Finance entered COVID, and people thought that its unsecured book will see significant NPAs. And all of those estimates of the general market were absolutely right. Bajaj Finance actually saw 10% of its loan book go bad during COVID. However, what Bajaj Finance did during the interim as a response to that was they completely transformed the business, made the business more agile, and today it has seen about 90% of its customer, which is the chart on the bottom left, 90% of its cross-sell franchise has the Bajaj Finance app already installed. All of this in a period of 2.5 years when Bajaj Finance went through a period of crisis. So the management team, which is extremely nimble, keeps on improvising and takes the benefit of every crisis that it has entered into. Similarly, we have seen that a lot of its flexi loans, which is again considered to be a large pain point, people thought there is a mode of evergreening. This is why Bajaj Finance does not see NPAs. A lot of these flexi loans have not only continued, but they've also started happening on the Bajaj Finance mobile app. Extremely high amounts of volume on the Bajaj Finance app. As a result of this, what we have seen in Bajaj Finance's history is every year, without fail, we would see a 20 to 40% correction in Bajaj Finance's share price, which is the chart, which is the blue line on this chart. A 20 to 40% correction without fail, because the market estimates the risk of a crisis correctly. Then Bajaj Finance management would take some action because they're extremely nimble, and then the stock price reacts on the positive, because again, the quarterly numbers are reported and they're as usual quite healthy. So in this sort of a scenario, we can obviously not only rely on history. What we usually do is we focus on whether the management team is as proactive as they've usually been. We have seen that the management team is extremely steady. We have not seen any significant attrition in the management team over the past 15 years. So one is the proactivity, nimbleness, agility, lethargy of the management team. That is one thing to judge. We can't judge their response to every crisis separately. And second is Bajaj Finance investing for the future? We believe that they are, whenever it comes to distribution, technology, risk, collections, etc. So we believe that, first of all, Jio's plans themselves will take time. Bajaj Finance, 2.5% market share, enough headroom for multiple players, even if Jio does well. Third mitigant for this risk is Bajaj Finance is an extremely proactive manager of risk and all of these external events. We would believe that they'll be able to manage this risk as well.
Thanks, Tej. That was quite comprehensive. And talking of management stability, right? There are a couple of questions, Mr. Vikhyat Dhingra and Mr. Manu George on Aavas. So how do you see that company kind of now shaping up, given that new management is in place, and how would you look at performance in that context?
Sure. So actually, there has been no fundamental challenges on business performance for Aavas. As we can see on the slide, almost all metrics are impeccable. AUM growth continues to be healthy. There is no decline or compression in spreads. Cost of borrowing actually continues to be best in class. Solid asset quality, no deterioration. All of that has resulted in steady ROAs and resultantly ROEs. The only thing that we are keeping an eye on is how stable is the senior management team now post the resignation of the CEO, because Sushil Agarwal, who's built the company, who's delivered all of these metrics which are there on the screen for 10 years, resigned abruptly earlier this year. Sachinder, who is the new CEO, was earlier at Kotak for about 15 years. We believe that he's built a similar business at Kotak for 15 years, again with solid, impeccable asset quality, a self-employed book of housing finance, which is extremely large. And that talks a lot about his conservatism and his management capability. So we draw a lot of comfort from that. Secondly, we believed and we were also a bit worried on what will happen to the top management team at Aavas once Sushil Agarwal resigns. It's now been about 6 to 8 months. We have not seen any senior exit post that. The management team continues to be stable. That's point one. Secondly, we also had fears on what the exact intent post the change would be of the management. Would we see an extremely risk-on approach? Would we see the private equity players wanting an exit and therefore reporting robust growth for a short period of time? But we don't see anything of that sort. The metrics and the focus on risk continues as it used to be. Thirdly, there continues to be an overhang on the stock because the private equity players are likely to exit sometime in the next 1 year or 2 years or 3 years. We don't know exactly when, but sometimes in the next, say, 15 months to 24 months. Because that overhang remains, we are watchful of what happens to the composition of the board when these private equity players sell. When that actually remains the only monitorable for us. We're not actually really worried about the business. The business, we believe, is well poised for 20 to 25% growth. We have spent a significant amount of time with the Aavas management team. We spent time with the top 10 people at Aavas last week in Jaipur. And we believe that it's a solid team, one of the best that we have seen for a business of this size and scale for a 10,000 crore rupee NBFC. The amount of investments that they've made in technology, people, and capabilities is exceedingly ahead of time. They can scale with the same people in technology to 10x their size without spending maybe significantly amounts of time or resources more. Also, with the exit of HDFC Limited from a large part of the market, it opens up a lot of room for Aavas on the liability side of the balance sheet. They will now be able to borrow from large banks where a lot of credit lines will be opened up, which were earlier reserved for HDFC Limited, because there is a specific allocation to NBFCs and HFCs. That is where Aavas will benefit. Secondly, Aavas will obviously also benefit from getting into a better quality of customer cohort or customer segment. So the opportunity remains extremely large. We believe Aavas can execute exceedingly well if they are able to deal with this transition of ownership, because now the management transition has happened. It's a transition of ownership of about 35 to 40% stake. Aavas can keep compounding really well.
Right. Thanks, Tej. Today it seems like the day for questions on managements. Kotak Bank and HDFC obviously had a change for a couple of years now. How do you see management changes, and do you think that these banks can kind of lose the momentum, become laggards as we go ahead?
So HDFC Bank is actually a good case study. As we saw, HDFC Bank CEO Aditya Puri retire after a long period of time. He ran the bank for about almost 30 years. People believe that there will be a slowdown in growth. Asset quality will be a challenge. Now it's been about 3 years. We've seen 20% profit growth every quarter, 20% loan growth every quarter, with about 1.5% of NPAs. The same impeccable metrics, which were people believe too good to be true, have continued even under Sashi's management. The other challenge that again people believed might play out was Aditya Puri had his own persona, and there were extremely big shoes to fill into. And people thought that a lot of people from the senior management team might quit under Sashi's leadership. Over the past 3 years, we've actually seen no one leave HDFC Bank from senior management. They've all stayed put. It's been the same management team. They've been the same metrics in the case of HDFC Bank. And it's actually been an improving sort of story. So solid loan growth for HDFC Bank, solid return on assets, 2% ROA is what they've focused on. So we believe that there has been no change in fundamentals for HDFC Bank. They've actually kept on improving on fundamentals. When it comes to Kotak Bank, it's been a different story when it comes to transition. In Kotak Bank's case, the owner remains the same. Uday Kotak currently fulfills 3 roles. Uday Kotak has the role of being a board member. Uday Kotak is the largest shareholder of Kotak Bank, and Uday Kotak is the MD and CEO of Kotak Bank. Out of these 3 roles, as it stands today, he'll continue being the largest shareholder. He'll also continue staying on the board of Kotak Bank. The only role that he steps away from because of RBI regulations is the MD and CEO role. And therefore, we believe that the stability is even higher versus a HDFC Bank. Because he has extremely high skin in the game, he has about 1 lakh crores at stake. And the people who worked with Uday Kotak, they are most likely to be the next MD and CEO of Kotak Bank. The same culture, a high amount of continuity will likely continue in the future. On top of that, Uday Kotak had already in a way transitioned into the role of a capital allocator. And that is the same role that he will continue to be in as he steps into a non-executive director, but who will still be on the board of Kotak Bank. Most people at Kotak, whether the successor of Uday Kotak or the top 50 people in Kotak Bank, all of them have been at Kotak for about 25 years. The same culture of conservatism, same management team. The additional comfort, the biggest comfort we draw is Uday Kotak continues to have a 26% stake and will continue to be on the board to guide the board and the company on the large strategic capital allocation calls that is historically taken exceedingly well.
All right, great. Now, on the theme of today's presentation on, history or learning from history, right? As investors, we've probably learned some lessons today. But do management teams really learn lessons, right? You have a table where PSU banks, for example, right? When management changes, do they reflect back, learn from mistakes? Even on the private sector banks, like Yes Bank has got lease of life now that it is trying to kind of normalize, stabilize. What are the chances that they don't repeat these mistakes?
One thing which has remained constant for PSU banks is, as we have seen, that the management keeps changing every 3 years. There is obviously by regulation, not a lot of stability when it comes to the top management. And therefore, if we go cycle after cycle, starting from 2003, again, for a long period, for about 4 or 5 years, a lot of people believed that there has been a change in the culture of credit, in the culture of way PSUs are run. It ended in disappointment during the GFC. Similarly, post the GFC, people believed that the cleanup is done. It was 2010-11, again, booming stock market and euphoria. Most people believed that the cleanup is done. However, when the asset quality review happened, 2014-15, people realized that yes, for a period of 2 to 3 years, PSU banks again post the GFC saw a good period of asset quality, credit cycle growth, but actually that was because most NPAs were not recognized. 2014-15, PSU banks were again struck by high amount of NPAs. And I think that thing continues. We've not seen any change in regulations around stability of management. Most of these PSUs are still majorly owned by the government. And as we have seen, government ownership and the objectives of the government are not really aligned with minority ownership. The third thing that we have seen is on leverage. If we were to look at leverage for most of these PSU banks, they fall in the category of where the blue line is. Leverage for these PSU banks is at 18 to 20 times. So even if a lot of things were to change, let's say that there have been incremental changes which are positive on underwriting, on credit quality, on intent. The challenge is that if you are at 18 or 20 times leverage, even if you are the best bank in the world, there are things which are out of your control, which can go wrong. For example, in the case of SBI would have 3 to 4 lakh crores of agri lending. A Bank of Baroda would have about 15 to 20% of its loan book lent outside of India, which is all foreign lending. These are things which even if you are the best of a lender, even if you're the best of banks globally, these are things which can go wrong. And at 20 times leverage, those mistakes get compounded and can result in a downside, which is quite significant. The other thing is, when we look at some of these names which have done well, it's extremely difficult to believe that all of these companies or all of these banks have together seen a change in intent, a solid CEO coming around, or some solid technology investments, which have resulted in all of these stocks doing well all at the same time. So it's obviously a result of a good cycle on credit quality, which has resulted in these stocks doing well. We'll just have to wait it out on our type of companies and our type of stocks doing well, and some of these companies making a mistake.
Right, understood. The banking system seems to be a lot of the growth recently has been coming from retail credit. And if we try and this question comes from Komal B, try and compare consumption, right? So say FMCG companies, the numbers that these are reporting, or the consumer-centric companies, the revenue growth numbers they are reporting, there seems to be some kind of disconnect between where retail lending is growing so fast and where some of the more retail-oriented businesses aren't reporting great numbers. So is there some way this can be reconciled? And given the space at which it is growing, would you think that there are some risks emerging in retail credit?
I think that's a great question, because we've also been pondering a bit about this, given it's been a complete dichotomy on what some consumer businesses have been reporting and the way retail credit has been growing, or MSME credit has been growing. And the way that we've been able to partially resolve this dichotomy, and we keep asking this to management teams, we keep asking this question to branch managers, or when we visit some of the smaller lenders or some of the banks, the way that we've been able to resolve this partially is that when we look at the penetration of credit in India, it's extremely low. There are three levers of retail credit growth in India. First of all, there is a lever of unorganized credit coming to the organized market. There is still a large cash economy, no matter what we believe, there is still a large cash economy underway in India. There are still money lenders who lend money, people who borrow from money lenders, which is still prevalent in India. That is the first layer of growth. As that shifts, cash shifts to the organized lending ecosystem, people borrowing from money lenders shift to the organized sector. That is part one. Part two is usually credit growth, and especially retail credit growth, is a multiplier of nominal GDP growth. So that's part two. Part three is when we look at private sector growth of retail credit, that is also on the back of significant market share gains from PSU banks. So all of this has resulted in, first of all, credit growing at 14-15% versus GDP growth of say 7-8%, which is on the back of, first of all, gains from unorganized sector and money lenders. Secondly, increase in penetration of credit. So we know a lot of our companies, so Bajaj Finance was present in only 20 towns and cities of UP till about 3 or 4 years ago. Today it's present in 300 towns and cities of UP, all in a period of 4 years. HDFC Bank had 1,500 less branches only about a year ago. Today it's been setting up 4 branches a day. That's all of it is on the back of increased penetration in credit. And third, market share gains. On the other hand, if you were to compare this to, say, an HUL or any of the consumer discretionary plays, there is no multiplier on top of maybe nominal GDP. Penetration is only a limited story. Beyond a point, penetration is not as rapid as it has been in the case of banking, financial services, and lending. There is limited scope for market share gains. And as a result of that, I think there has been this divergence in the way consumer companies have reported numbers versus what retail lending growth has been. On the question of, do we see this as a risk? I think this is definitely a risk, and this has been highlighted by some of the companies that we hold. Bajaj Finance, for example, in its recent most call said that the biggest risk in all of this euphoria and all the great numbers being reported is that there has been an extremely high amount of supply of credit in some locations, in some geographies, and especially in unsecured loans. So what Bajaj Finance is doing is it is starting to see that yes, the consumer or the borrower has the ability to repay the loans that Bajaj Finance has given as we speak today. But what happens when the borrower's leverage increases by 20%? What if a microfinance institution or a fintech app gives 20% more credit to the same borrower? What happens to the repayment ability of that borrower at that given point in time? Because the supply of credit has increased rapidly, because all lenders have started believing that this is a 1% gross NPA market. So that is when proactivity on the side of the management team and extremely high underwriting capabilities and focus on risk will come into play. We believe if there is some blowout on the unsecured side, or if there is an increase in slippages or NPAs, it will actually work out well for some of our companies.
Great. Thanks. That was, I think, quite good perspective of where the dichotomy lies. This is one interesting question. I'm guessing you must have answered this in the early days of KCP. Maybe it's time to reinforce this. That when do you sell a stock? Actually, the specific question is will you book profit on the stock? So if you can, distinguish between booking of profits and exiting.
Sure. So one largest usually reason for exiting or booking profits on a stock is when we see that fundamentals have deteriorated, or there is a governance issue, or we believe that the same fundamentals might not continue in the future. And that is when our perception of a stock changes. And therefore, we believe because our perception of the stock has changed, great fundamentals is why we buy a stock. If they are not likely to continue in the future, or there is a blip which is unexpected in the journey of a company, that is obviously the first reason that we sell a stock. And that is not related to the stock price or the valuation or any of those factors. The second reason is when we believe that the stock is already pricing in what we've baked in. If we believe a stock is likely to grow at 25% and it is pricing in, say, 28% or 30% growth, then we obviously book some profits from a stock. The third reason is when we believe on a relative basis, there are better opportunities available. And that is when we do rebalancing within the portfolio. Say in our portfolio, we've done that recently in the case of HDFC Life and Prudent Corporate. In the case of HDFC Life, during February, March, April, we saw the stock went down to 450 rupees, 470 rupees on the back of some changes in the budget. We believed that it was overdone. We thought it was a closed-ended problem of 5 to 10% of the company's profitability being hit. The market believed that it should result in a 40% stock price correction and not a 5 to 10% correction. We bought more of the stock, but for that we obviously had to sell something. So that's when you could say, booked profits in one stock, bought HDFC Life. Similarly, with Prudent Corporate, there were some changes announced on the mutual fund regulations on total expense ratios. Stock went down to 850 rupees, 900 rupees. We bought more of the stock, but again, we had to sell something to buy that stock. So that you can again say is profitability. The third reason is simply because we believe that valuations have become so expensive that we just have to sell the stock. We'll not be able to exit the stock at such lucrative valuations in the future. However, as you can see on the screen, that's not the case with any of our companies, despite what it might look like from the outside. That the market is overheated, mid and small caps are doing extremely well. This is a euphoric market. But if you look at our stocks, some of these companies are trading at valuations lower than their own history. They're growing at an extremely robust pace. However, we might even in some of these stocks, trim them if we believe that relative opportunities are available in the rest of the portfolio.
All right, that's well understood. Now we have a couple of questions on microfinance, right? Do you see that as an opportunity? Anything interesting that can be part of KCP?
Microfinance as a space has its own history, where we have seen that in the early part of a cycle, again, microfinance does extremely well. Microfinance loans are essentially unsecured loans given at 25, 28, 30% for the high amount of risk in the underlying loan. Because these are average loans of average ticket sizes of 12,000 rupees, 15,000 rupees to people of the lowest strata of society who might already be having access to informal sources of lending. And that informal source of lending might be the one which is being replaced by the microfinance institution. This is also a part or segment of the lending industry which gets impacted the most by macro, because we've seen historically whenever there are elections, say for example around the corner, and there are loan waivers announced, this is the segment which gets impacted the most. And in the past 5 to 6 years, if you were to take any macro event, that is the sort of macro event that would impact MFIs the most. Let's take the example of demonetization. In the case of demonetization, MFI loans are usually repaid and also sometimes lent in cash. If overnight, we would have been owning an MFI company, if overnight all notes of 500 rupees, 1000 rupees would have been banned, microfinance institutions actually saw a 15% NPA in a period of 3 months. 1% NPA being reported in 2016, that suddenly turned out to be 15% in a period of 6 months, because some of these borrowers were somehow not able to repay most of their loans. On the other hand, Bajaj Finance was also doing unsecured lending, but it saw its NPS stay at 1.5%, no change in NPS, same unsecured lending, 20,000 rupee loans, but to a completely different category of customers who are at a score of more than 700 on CIBIL versus a new to credit customer, lowest strata of society, maybe some of them not having a bank account, dealing in only cash, and an over leveraged customer. Let's take the second instance of introduction of either GST or the ILFS crisis. ILFS crisis, liability side of most NBFCs hit the highest. A lot of NBFCs were not able to borrow or were able to borrow at 9%, 10%, 11% sort of rates. Because banks know that MFI as a segment is pro-cyclical, extremely high risk, the first lines to be withdrawn by the banks were the microfinance institutional credit lines. So again, MFIs got hit the hardest, 2018-19, they got hit the hardest on the liability side. Let's go to the next crisis, COVID. Because in COVID also, we saw the lowest strata of the society getting hit the most. MFIs saw a 15% gross NPA number getting hit through the first wave of COVID and then again through the second wave of COVID. It's after this sort of 15-20% gross NPA number that these microfinance institutions today are reporting robust growth. So this is a period of recovery, but because they go through such deep cycles, microfinance as a business is extremely pro-cyclical. On a cross-cycle basis, post 2011, when regulations were introduced on how much you can charge on these MFI loans, there are caps now introduced on how much you can charge on MFI loans. Earlier, these MFI loans used to go out at 45-50%. 45-50% interest rates on some of these loans is what lenders used to charge. And that was actually the right amount of pricing for the risk that they used. Now on a cross-cycle basis, if you're charging 20 or 25%, these companies on a cross-cycle basis don't make enough return on equity for the amount of risk that they take. And therefore, we have stayed away from these extremely deeply cyclical businesses, which entail a high amount of risk. And the general theme, as you would have noticed in our investing, is we try and stay away from anything which is pro-cyclical, risky. We're just generally conservative investors.
Yes, that we are. Tejon, there one question on valuation, right? Specifically for banks and which are such large banks. How do you deal with the terminal value in these cases? in your future forecast, let's say X many years from now, it will be so large. Do you keep expecting growth to be continuing at a similar pace as today, or how do you factor future growth rates?
Sure. So we can approach, because valuation is both an art and a science, right? So we can approach this in multiple ways. We can approach the valuation of banks by way of looking at the numbers that are on the screen. How are they trending versus historical numbers? This is just a very simple thumb rule. If the business has not changed dramatically, if it's earning the same return on equity and doing the same growth that it used to do in history, it should be trading at around the same multiples that it used to trade. That is one very simple way of looking at valuations. The other way of doing valuations is looking at residual income based valuation for lenders, insurance companies, banks, and NBFCs both. When it comes to residual income method of doing valuation, what we do is we project growth in the future for let's take the example of HDFC Bank. For HDFC Bank, it's historically done 20% growth irrespective of upcycle, downcycle, along with 17-18% return on equity. We project, in the case of HDFC Bank, say 18 to 20% growth in the future. On that growth, we project a specific return on equity number. Let's assume that return on equity number is 17 or 18%. We project how much is the return on equity in excess of our cost of equity. So the gap between the return on equity and cost of equity, our assumption of cost of equity is 12%. That gap of 6% over the time that HDFC Bank is able to earn more than 12%, it is discounted to its present value. That discounting over its present value in the case of HDFC Bank gives us the present value of so-called traditional free cash flow. In this instance, in the residual income method, we don't assign any value to the terminal value of HDFC Bank. Because what we are doing is we are adding today's net worth, adding 18% minus 12%, which is the 6% gap between the cost of equity and HDFC Bank's ROE, multiplied by the overall capital deployed. So 6% into overall capital deployed, that discounted to today's value plus today's net worth will give us the free cash flow estimate over the whole longevity of HDFC Bank, rather than having a terminal value, which we usually do in the case of most other companies. Over here, we believe HDFC Bank will eventually come down to cost of equity. And this is what we have seen historically with banks, lenders globally. That HDFC Bank will eventually only earn cost of equity. And again, being conservative, we don't assign any terminal value to a bank or an NBFC. Despite that, we believe today's valuations are more than justified for a HDFC Bank. Over in the case of banks as an industry, or in the case of lending as an industry, over 10 years, 20 years, 30 years, 40 years, no matter what time horizon we take, and this is RBI published data, we have seen credit growth anywhere in the range of 15% to 16 to 18%. And these are extremely long periods of time. That if credit growth is 14 to 16 to 18%, even the largest bank can grow at healthy rates of growth over a 15 or a 20-year period of time.
Understood. Thanks. Tej, there's one question from Puneet Agrawal on the smaller lender in our portfolio, MAS. How do you see the prospects and growth for MAS?
So MAS Financial Services is a part of Little Champs. It's not a part of the Kings of Capital portfolio, one clarification. MAS Financial Services has been doing well. It is growing at 25% for the past 2 years. Even if you were to take a long enough time period, 2013 to 2023, MAS Financial Services has grown at a 25% CAGR. And this is both loan growth CAGR and profit CAGR. What we like about MAS Financial Services is the way that it underwrites risk. It has the ability to slow down growth if it believes that conditions are not ripe for growth. And it does not focus on market share gains or loan growth. Its sole focus is on bottom line growth. Its focus is on doing around 18% return on equity with 20 to 25% top line growth, extremely high skin in the game. The promoters themselves own about 75% of the business. And therefore, we believe they'll do what is right for the long-term growth of the business. They are venturing more onto the retail side of the business. They've historically been 50-50 on NBFC lending and retail lending. Now that has flipped to about 70-30 or 75-25 is what maybe it will eventually end up as. But the ROA profile remains similar. So the business continues to do well.
Right. Yeah. Now this one, going back to HDFC Bank, right? How does their aggressive branch expansion plans that they have? How does this impact both the costs that they will bear, and is there enough room to kind of how close can you have two branches to each other without them competing in the same catchment for deposits? And given that online digital banking is kind of the buzz, why would anybody go and expand branches by so much?
Sure. So just to give context on some of these questions, right? Bajaj Finance, like I said, has a 2.5% market share. HDFC Bank, even after the merger with HDFC Limited, will have a 13-14% market share. SBI, which has a 20% market share today, is growing at 20%, despite being a PSU-owned bank, despite being the largest bank in the country. And that's the sort of credit opportunity, that's the size of the market that we are talking about. All that Kotak Bank or a Bajaj Finance have to do is increase their market share from 2.5% to 4% over the next 10 years. And they'll compound at 20 to 25% easily. All that HDFC Bank has to do is grow from 12 or 13% market share to 18, 19, 20% market share over the next 15 years, will compound at 20%. So we're not talking about something which is unprecedented. Even SBI, like I said, is growing at 20%. So these are numbers which are quite possible when it comes to size. In the case of HDFC Bank, why it is adding branches, it's largely for the liability side. HDFC Bank has a large task in front of us, in front of it, of getting about 4 lakh crores of deposit in this year, and then growing at about 18 to 20% on the deposit side every year for the next 3 to 4 years. That is why it needs branches. For lending, it's much easier to do it through an app or to do it digitally. While for taking in money, the general tendency of most Indians is they need a branch near them. They need to see physical presence near them. And that is why we believe that this strategy is right, especially for HDFC Bank. Historically, it's not something new that HDFC Bank is doing. Historically, 2010, 11, 12, 13, HDFC Bank has grown branch count by 15 to 20%. Similarly, this year, HDFC Bank is growing branch count by about 20%. That will, and if a bank is growing, a bank like HDFC Bank is growing branch count by 20%, we can all imagine the amount of growth that we can see on liabilities and on advances, because branch count itself is growing by 20%. If we were to see improvement in productivity on top of that, HDFC Bank can easily do 25%.
Understood. I think we'll have time for maybe one more question. And this is on, on defaults. Now, if bank loan defaults increase, right? Most of it would be because of macro conditions, like you mentioned, right? Will that be different between how will the reaction of stocks to in private sector and PSUs be materially different? Will the stocks fall in both cases, and one will be relatively a sharper fall versus the other? Because the assumption is that everybody gets impacted if there's a macro shock that leads to a greater bank NPAs. So how would you evaluate this situation?
Sure, I think if a large accident happens in the system, there will be a temporary period of pain for everyone. The initial reaction usually is quite knee-jerk, and it treats all lenders as the same. And then it will be a period of reset. And as most investors start analyzing balance sheets and exposures of who is exposed to what and how by how much, that is when we'll again start seeing a bit of sanity in the market. And we've seen this historically. We've seen demonetization when Bajaj Finance corrected significantly, HDFC Bank corrected significantly, but it was only for a period of 1 month or 2 months. And then there was a recovery. But MFI lenders did not recover for a period of 2 years. In the case of, let's say, DHFL and the housing finance crisis, a lot of housing financiers in 2018 did not see any recovery for a period of 2 or 3 years. In the case of Yes Bank crisis, we saw a lot of small and mid-sized banks not recover again for a period of 4 or 5 years. But HDFC and Kotak saw massive influx in deposits because everyone realized they are the safest place to be. So depending on what the type of crisis is, initially we'll see a knee-jerk reaction. Even our portfolio, I'm sure, will see some reaction and we'll also suffer. But then we'll see a differentiation in stock prices based what the exposure is. And we believe that we will be relatively much more immune to any sort of crisis, whether it's retail or corporate, when it comes to an accident or when it comes to risk mitigation.
Got it. I think this is it. I think we're almost out of time. So thank you everyone for joining in today. If there are more questions, you can write to us sales@marcellus.in. If there are any pending questions we could not take today, we'll try and get back to you with the responses. Thank you very much and have a good evening. Thank you, Tej.
Thank you.